Welcome to the Get Real Podcast, your high-octane boost of full-on reality therapy for personal, business, and investing success with your host, Ron Phillips, because somebody's got to tell it like it is.
Hey everybody, welcome back to the Get Real Podcast. Ron Phillips, Heather Marchant at your service.
Yes.
Gonna talk about games today.
Mm-hmm.
And, you know, not necessarily the fun kind that you want to play, but this is important. So hang in there with us till the end. We're going to talk about a lot of things that we are seeing in the market right now that I guess they give real estate people not the greatest name. So that's what we're going to talk about today. Fun stuff. We'll probably add in some humorous anecdotes because that'll keep this light. But this is really important. You guys need to understand this stuff. So with that said, let's crank this up.
Yeah, I remember us talking, Ron, and saying that as things shift and change, lending will shift and change, right? There'll be other loan products that pop up and there'll be other opportunities, even though we're in a high interest rate environment. And that's happening. We're seeing lots of cool loan products. And I think this is kind of something similar along that same vein of as things shift and change and interest rates are high, we have some proformas and marketing information that gets a little bit creative, and you need to know what you're looking at and be a little more careful in looking at your numbers.
Yeah. And I mean, I think some people are being genuine with their creativity, and I think some people are being complete scoundrels.
Yeah.
But if you know what you're looking for, then you can make apples to apples comparisons. And that's the real challenge, is that everybody's shifting numbers around to make things look better instead of just providing the numbers, because the numbers look good anyway. I don't understand why the need for all of this creative display. Creative deals is a completely different story, right? I mean, we're all about making creative deals. The problem is in the creative display of information. And that is really what we're going to talk about today.
I love that, Ron. That's a really good distinction, because you're right. It's the display of information that's going to vary from proforma to proforma. And we've talked about that before, you know, that you have all these different proformas and calculators and all these different things out there, and knowing what you're looking at, because you can look at cash on cash return at one company and then another company shows cash on cash return and it's calculated differently, but it's not really super clear that it's calculated differently, you know, and beefed up a little bit.
Yeah. And you know, cap rate is a cap rate, is a cap rate, is a cap rate. And cash on cash return, I guess it's a little more ambiguous than a cap rate, but it's still your net. This happens a lot. You'll see coaches online and they'll say, you know, learn how to do a 7-figure business from somebody who does a 7-figure business. And I know perfectly well that those people don't have a 7-figure business. Now, this is really important. Like, this is the creativity that goes into this. If I flip 5 houses and they're all $200,000 houses, technically, when I sell those on the HUD, I have sold 7 figures worth of real estate. Now, did I buy those? Yes. Did I sell those? Yes. Is that $1 million that came in revenue? Technically, yes. But, I mean, if we're being honest, you probably made $40,000 on that $200,000. Let's be generous. You made $50,000 on that $200,000 house, okay? Which you probably didn't, but let's just say you did.
Yeah.
That's 50,000 times 5. That is a completely different business than the creative display of information in the video online that is to get you to trust them to help you build a 7-figure business when they themselves don't have a 7-figure business. They have a decent 6-figure business, and there's nothing wrong with that. They should just lead with that. Hey, look, if you're getting started, a lot of people when they're getting started would love $250,000 in their business. So just say, hey, learn how to make $250,000 from somebody who made $250,000. You know?
Yeah, it's important. I agree. And to be educated to know kind of what techniques are being used to display the information in a way that makes everything look better or not apples to apples. Go ahead.
I'm sorry. The other problem here is that, okay, if you're running a business and you did 5 flips, right? 5 rehabs, and there's a difference between your gross margin, your gross profit, and your net profit.
Mm-hmm.
Okay. So I was still talking about gross profit. Okay. Because there's still expenses that come out of that 50,000 times 5, that 250,000. There's still expenses that come out of that because you probably spent money on marketing. You might have an assistant or two. You might have some people in your office. That means they really didn't even make $250,000.
Mm-hmm.
I just be more highly tuned for this kind of stuff, because when the markets shift, which, it is shifting, people do get pretty creative, right?
Mm-hmm.
And the people who are out there doing, and now it's harder to do, instantly become coaches, and it's not a lie.
Yeah.
Not a lie to say it's a 7-figure business. But it's not the entire truth, and it's not a lie to say it's a $250,000 business. But that's way more honest than the $1 million business, and it's still not the truth.
Yeah.
I think if you're telling people learn how to make $1 million from somebody who's made $1 million, the person ought to actually have made $1 million. Like, they should have netted net. They should have netted $1 million. Otherwise, don't say it.
Yeah, I think the question to be asked, Ron, is if you found out that they had marketed it that way, and that you had misinterpreted or misunderstood the information given, would you be frustrated? Would you feel like they had misrepresented? And I think I would.
I think any fair-minded person would. So
Yeah.
If you're doing that, stop doing it.
Mm-hmm.
If you're looking at an ad, man, ask some questions. If you're planning on getting coaching from somebody who's advertising like that, ask them if that's gross or net. It's a simple question.
Yeah.
Is your 7 figures gross or is it net? Simple. Somebody should be able to answer that.
True.
Sorry, I completely got us off track here. That's not really
No,
what we're going to talk about. But
I think the point was good, though, Ron. Important. I think you're right. Just the display of information, and that it's not a lie. So this isn't, I think our intention, I guess, is not to call people out, but more to say, be aware of what you're looking at, right? Be aware of the display.
I don't get on there and go, you're a liar, and I know you're a liar. I just scroll past it and go, man, that's really too bad.
Yeah.
That's really too bad, because somebody is going to buy coaching from you because you misled them. So, so don't do that. And if you're the person who's going to buy coaching, just ask a follow-up question. That's all I'm suggesting.
Yeah, no, that's a good point. So a couple of the techniques, let's go through a couple of them, I think, because there's a few that we're seeing that is just, again, a display of information. Just be looking for it. I would say one of the first ones we see is interest rates being super low. And clients will send us proformas and say, man, this interest rate's killer. Why is yours so high, for example, right?
Why is everyone's other than this guy's super high?
Yeah. They must have some secret sauce or some kind of super cool connection that gets them this crazy low rate. And there are some things you can do to get a crazy low rate, but across the board, no. So this one technique that I've seen is an adjustable rate mortgage, and it's a shorter term. Make sure you know the loan terms on the proforma. This one I was looking at the other day was like a 7-year ARM. So where our proformas are 30-year fixed,
probably with a 2-1 buy down, right?
Yeah.
So it's not even going to stay at 3.99 for the entire 7 years, because you have an introductory rate. It's like a credit card, for crying out loud.
Yeah, that's true. Yeah. And that's pretty common. So if you see a really low interest rate, ask questions. Ask why it's so much lower than everybody else, and where is that coming from? Because we've seen some companies that just put a low interest rate without any kind of background as to how that's even going to happen, but they just throw it on there at a low interest rate.
Yeah, you call them and you're like, well, you can buy the rate down.
Yes.
Like, well, yeah, I know that I can do that, but that's I mean, you should at least put that on your pro forma, right? We're counting that the buyer is going to pay 5 points to buy the interest rate down. By the way, this is a 2-1 buy down on a 7-year ARM. Boy, that's a lot of jargon. It's a lot of jargon. Can I even unpack that much jargon for you? Okay, so an ARM is an adjustable rate mortgage. So it's 7 years adjustable rate mortgage. A 2-1 buy down buys the rate down only for a short term, right? So you may get a ridiculously reduced rate for your first year, and then it steps, and then it steps again, right? So anyway, those aren't the same as a 30-year fixed loan. Just it's not the same thing, right? So when you're comparing, again, compare and look. If you want a 7-year ARM with a 2-1 buy down, well, that's cool, but you should at least know that's what it is. And if you're the person who's paying the points to buy it down, you should know that too.
Yeah.
That's all we're saying.
Yeah, for sure.
Comparison's sake.
Yeah,
and for hell's sake too.
Well, just know what you're looking at, right? Like, take a minute and make sure that you're deciphering the information. And that probably goes across all of these different techniques that are being utilized. Another one I've seen utilized is no taxes for the first year, especially on new construction. We all know that there's going to be taxes on new construction. For those that aren't familiar, new construction is assessed later. And so you don't necessarily know for sure what the taxes are going to be until the county assesses the property.
But we know they're not zero. Can we just all agree that they're not zero? Very
confident on the zero. Not
okay.
zero.
The other thing is if they don't put zero, because that is just completely. I mean, somebody puts zero for taxes and they don't have. I mean, it is possible to have zero taxes, people. It really is.
Yep.
But you have to have a tax abatement for that to happen, and typically new construction doesn't have a tax abatement. So let's just, typically that's not going to be the case. But what's more common is that they put the lot taxes on there. And so the taxes, I mean, there's taxes listed, but they're just really low, very inexpensive. Also not real. It's also not real. It's not real.
Yeah. And again, this is a display of information because if they're putting the current taxes on there on the land, they're not lying. But then when you get into it and you own the property and it's assessed, 6 months into ownership, and that number goes up to the point that you're negative or don't cash flow.
It's so misleading. It's so misleading. Yeah. And then unfortunate because, oh boy.
Yes, I agree. I'm just going to keep saying all the ones I think of, Ron, and I'm probably going to leave none for you to think of.
I think you should. That's okay.
Another one I'm
still thinking about the last one. Somebody put zero in for taxes. I just can't believe it. We've seen these guys. These are all, we didn't make these up. This is all stuff we've seen on Proformas. All right. Yep. Sorry.
Another one we've seen is actually one that we had to implement a change on our Proforma for. So I think it's actually good to discuss an incentive for a year of no management fees, just putting zeros on the expense of management fees. So we had to add another line on our Proformas for other income so we could throw the management fee on there, but then throw the credit back on there for that first year, right? So that way it's transparent. You know what the property management fee will be after the first year. So it just makes the performance look so much better without a management fee. So
except for you're going to have it. And if it's not listed there, you don't even know what it is. So you can't calculate your numbers.
Yep.
So put it on there and be clear about it, right? This is the other income is for, and listen, people don't have to display things the way that we display them. There's probably, I don't know, half a dozen other ways you could display that and it'd be perfectly legit. But when you put zero and there's no explanation, that's a problem because of course there's a property management fee unless you are managing it yourself, which if you're managing it yourself and you're buying it from a turnkey provider, there's a problem there. That's not exactly how turnkey properties work.
Yep.
Oof.
Exactly.
Okay.
And then I think one of the last ones I'll mention is the cash on cash return just being calculated totally differently. The one I saw recently was cash on cash, which is your cash flow, annual cash flow divided by down payment is how we calculate it. This added in depreciation. And so on the marketing, it was, here's the cash on cash return, but you had to kind of dive into the pro forma to figure out that they were citing the cash flow plus the first year of depreciation, which gave a decent bump to the ROI.
And it's not entirely inaccurate.
Yep.
But it is inaccurate. I mean, it's like it's the little, it's not even a lie. It's like it's a half truth. It's because, when we've talked about this before, when you figure in your depreciation or your tax incentives, it is money that you don't have to pay the government. So legitimately it goes in your pocket. But that's not the way that it happens. It's like you're not going to see it on your P&L. They're not going to send that to you on a monthly basis.
Yeah.
And we have that on our pro forma. So it's not like this is not a return that people should think about or figure. You should. However, it isn't cash flow. Now, I have seen this done really well on some where they actually include it in cash flow, but they have a pre and post tax cash flow so that you can clearly see both. Like I said, there's plenty of ways to do this that is above board.
Yeah.
But if your cash flow number, if the cash flow number that you are looking at just says this is the cash flow and there's no explanation for it, you're probably going to assume that's the cash flow that you should be getting on the property. And when you get your first statement from the property manager, you're going to be mad at the property manager. It's not the manager's fault.
Yeah.
They're going to take all the heat for you not getting what you were promised. And then you're probably going to be irritated at the other people, but they will have already gotten paid and, so whatever.
Yeah.
It really bothers me when people don't just explain what's going on very clearly for people to see.
Yeah,
and
I agree.
and there's a reason they're doing it. It's because what Heather said, that gives it a pretty decent bump when you throw another 3.5% to 4% on your cash flow. That's a pretty decent bump.
Exactly. And I think one thing that you just made me think of, Ron, is when we go to the property managers and ask about rents, it's so great that we can say, look, man, we're trying to set you up for success. Like, we want accurate rent numbers so you're not the bad guy later. Like you mentioned, I mean, that'd be really frustrating to be the one under fire because someone bumped the numbers,
Yeah, I mean, it's pretty obvious, I think, that the people who are marketing properties this way are not thinking about anyone else but themselves.
Yeah.
Or they would realize, oh my gosh, this is probably going to be a problem for the property management company. It's definitely going to be a problem for my client who thinks that it's this way. But even then, if they call in and ask, you could go, well, yeah, I mean, this includes the taxes. And then you might be able to make them not so irritated. But at the same time, if it were me, I'd be like, well, why didn't you just put that on the pro forma in the right way so that I could see that that's what is. And the easiest way to do that, if you actually want to list what the post-tax cash flow is just call it post-tax cash flow. Super easy. It's not hard, to be honest. It really isn't. It's pretty simple. So,
it's true.
I watched this show Blue Bloods.
Oh yeah, you've talked about Blue Bloods, I think.
I like Blue Bloods. And Tom Selleck, I used to like Miami PI too. That dates me.
I know. I think of that too.
Yeah. And I used to have 2 Dobermans. And there's a lot of you out there right now who are going, what are you even talking about, Ron? Just look it up. It's pretty cool. Anyway, he does this. You guys are going to hear, occasionally I do this like thump thing. My wife keeps calling me Tom because I keep doing this. And I'm not doing it because he does it. But on Blue Bloods, anytime somebody gives him like information that he doesn't like, he starts like thumping his fingers. Like anybody who's watched Blue Bloods is going, oh yeah. Well, that's what I'm doing over here. So if you hear that, I'm just like, this is my irritated thump of my hands on the desk. Occasionally it gets really loud. I'm pretty animated at that point when it gets really loud. But dishonest people piss me off. I don't know why. It does. It just really irritates me.
It just takes some of the fun out of it for me to just not be to have to feel like you have to be a detective and look for this stuff. I don't know. I just wish it was just more transparent across the board. And to some degree, it'd be nice if there was like a standard, some kind of standard pro forma.
It's just, there kind of is a standard. Cash flow is cash flow.
Yeah.
It's
True.
I mean,
That's
look,
a good point.
if you own a business out there, you know how this works.
Yeah.
You have your gross revenue. Okay. After gross revenue, you might have some cost of goods sold. In this case, we're talking about rental properties. They don't. They just have expenses, right? So you have expenses, and at the bottom of the expenses, you're left with something, or you're left with nothing, or it's negative.
Mm-hmm.
It's really not much more complicated than that. That's the standard. Take all the expenses out. What's left? Cash flow or negative cash flow. One of the two. It's not any more complicated than that. And if you want your cap rate, just take the mortgage out. Also, pretty simple, right?
Yeah, true.
It's not as if there's not standards.
Yeah, maybe you're right. Because maybe the definitions, I'm like, well, maybe my definition's different than theirs. But you're right. They're just kind of adding things to the definition. They're labeled
it is
most
now,
of the time. But
it is now, but the reason it is now is because it's harder to make the numbers work so that they're easier to sell. But here's the thing. If you actually just look at the numbers, just take a step back and look at the numbers. Okay, let's say you're getting a cash flow and it's 5 to 7%, which is not going to change anybody's life. It's not like the greatest thing ever. It isn't like 2010, 2012 where you could get 35, 40% cash ROI. It's not like that.
Yeah.
But look, it's better than a poke in the eye. It's pretty good. But here's the thing. Here's the thing. It's as good as you're going to get in the bank. And here's the other thing. You do have tax return. You do. There is a return based on your depreciation. Mm-hmm. And it's, somewhere between 3 and 5%. It could be more than that if you can cost segregate it, right? But keep it simple. Now you're at somewhere around 8 to 10%. And then you have somebody paying down your principal. That's another, 3.9, depends on the amortization schedule and what you're paying for interest, but it's another few points. Now you're double digits. And then you've got appreciation. And even at the lowest appreciation, when you're levered into the property, it's a multiplicative effect, which is most likely going to be another double digit, which puts you north of 20%. You don't have to fudge the numbers. It is just not necessary. As a matter of fact, Heather, you remember back in like 2010, 2011, 2012, 2014, all these years, we would build pro formas. People didn't believe us.
I know. I remember
It's
well.
too good. The numbers were too good. And nobody believed that.
It's so frustrating.
Now the numbers are back down to where people are like, well, what's a good return? I don't know. 5, 7%, 8. They say I get 12% in the stock market. Nobody actually sees that, but they say I get it. Average annual. But most people we ask is somewhere between 5 and 8%. Okay, so if you get that, plus you get 3 bonus ones that put you over 20%, that's really good.
Yeah, I agree. Okay, and most of the time when people call us and we say, what's a good return for you? That's what they're telling us, right?
Yeah.
So, yeah.
Yeah. And they're like, well, would you like an extra one and an extra one and another extra one? Yeah. That sounds great. And guess what? We didn't have to pull any fast ones to get them there. Yeah.
Just transparency.
We probably flogged that horse sufficiently today. So watch yourselves out there, people. Not everybody is, on your side, I guess.
Yeah, they're on the side of making money. So be careful.
Yeah, they're on their own side.
I mean, we're not anti-making money, but we don't.
No, I'm pro money. I'm pro money. I hope you're pro money. That's what we're trying to do, is make sure that you actually make some instead of losing some. It's brutal when that happens.
And you're not frustrated later. Good point.
I mean, short of the Tom Selleck reference, I think, I hope this was really helpful for you guys. You're gonna see more and more and more of this. It's really crazy. Just be safe out there, people. Be safe out there. Till next week, get out there and make something happen.
This has been the Get Real Podcast. To subscribe and for more information, including a list of all episodes, go to getrealestatesuccess.com.